So today is Tuesday, August 13th. This is week 6. We are in the home stretch for the semester. This will likely be a shorter class. We're just going to kind of go over the homework assignment, the exams, set up the group projects next week, and then I'll give you the balance of time in class today to work with your teams on your group projects. So I think that might be efficient. But before we get into all of that, questions about anything?
I have a question about the multiples, and how to get those for the group projects, but you might go over that later, so I don't want to like overstep.
Yes, we will cover that tonight. Basically, what we're going to do is kind of in real time. I'm going to be pulling up Bloomberg, and then you can tell me which peers you want the data for. And so, well, I'll give you guys time to work on your group projects tonight. When we go to that phase, I will start downloading the data and putting it onto Elms. So I'll put the data on later tonight.
Perfect. Thank you so much.
That will be something that we will cover tonight. So great question. Other questions? Anything? All right. So let's start out with last week's homework assignment on multiples. So I'm going to upload the solution actually while we're talking here before I share it to the file section. I'm going to put it into the week 6 folder. I'm going to put 2 files there. One is called homework help. And the other is going to be the solution file. Right, so let's start out with Zoom Go. Let's start out with the data. So for Procter & Gamble, Estee Lauder, and RKT, basically, this was the second year EEO net income. This was the cost of equity for each firm based on the wax screenshots. This was the second year forward PE for each of the 3 companies. And looking at the 4-year ROEs, your numbers might be plus or minus 1 or 2% of this, but came up with kind of a long-term ROE of 34, 33, and 27 for the 3 companies respectively, given the data. So before, and then solve for the G's. But before I go any further, do I need to show where the data came from? Does everybody kind of know where the data was? Hopefully have similar numbers to this. Questions about that? Happy to cover that again if we need to.
So just to check, it was okay if you did like the averages of the ROEs over the.
Yes, which
Okay.
is actually the point I wanted to make. This is key value drivers. Okay? Key value drivers is basically a growing perpetuity. So the key here in the key value drivers is these are perpetuity values. They're not 1-year values. They're forever values. Okay. So that's the point. That growth rate is not a 1-year growth rate. It's the perpetuity growth rate, right? Like think of like a 30-year growth rate, right? That's not a 1-year ROE or even a historical ROE. That's what we believe to be representative incrementally of the ROE in the very long term. Okay, that's what we're trying to get to. So whether you average, whether you use a more recent year, whether you use a previous year, the whole point is whatever value you put in for ROE and to some degree ROIC in the next tab is basically what you're saying incrementally. This is what I think this firm is going to do over a very long period of time. Okay. So that's why we have to be careful about historical data. All right. And Estee Lauder was a good example, right? Because if you look, and actually I'm going to share my desktop and jump back and forth. If you look at Estee Lauder, the EE at the RV, it's in the Procter & Gamble spread here. The problem is last year, for whatever reason, Estee Lauder, 4.78% ROIC, negative spread, did not have a good year. Okay. Now, I didn't give us any data on analyst reports or whatever. Didn't expect everybody to get out the 10Ks and kind of read what was going on. But clearly, it was not a very good year for Estee Lauder. Okay. Now, the thing is that representative of their future? And this is what I tried to hint at in the announcement. But if you look at the EEO, and we can see this by looking at ROE as an example, the ROEs start to substantially improve. All right, they go from 18% last year to 37% by 2027. Okay, and you can kind of even see it here. You can see the revenues growing, the profits are doubling, the EBITDA profits and pre-tax profits going up 70-80%. So clearly the next 4 years are much better than 2023 was from an ROIC standpoint. Okay. Now, again, Bloomberg's not directly calculating ROIC, but again, I told you that ROE and ROIC are kind of correlated. And so in that context, we know that that's probably more of an outlier for Estee Lauder, and longer term, they're probably going to return to a more reasonable level of profitability. So that's the question, like, what is that reasonable level of profitability? And so that would be the challenge. Like if you had put in, you know, a low ROE, well, put it this way, if you put in a negative spread, then the problem is, and I'm just mixing metaphors here, whether it's ROE or ROIC. If you put a negative spread, think about this. How do you get a high multiple with a negative spread? You can't have a high growth rate. The higher your growth rate, the worse the multiple gets. So the only way that you could get with a negative spread to a multiple of about 22 is you would have had to put in a big negative growth rate. Okay. And so again, when you're talking about growth that's negative in perpetuity, I want to talk about it one of two ways. So there's the Merck example, which we did last week, which says Keytruda, which is the best-selling drug in the world for the next 5 years, is going to see its patent expire, and all those sales and profits are going to start to erode. So their negative growth is indicative that today is better than tomorrow. It's not that Merck's going away. It's just these are the best of times. And once that patent expires, they don't have something to replace it. So they're going to actually see some pressure on their profitability after 2028. That's what the market's viewing them today. So a negative 1-2% growth kind of makes sense. And again, back in perpetuity, take today's sales and profits, multiply by 0.99, 0.99, 0.99. That's not unreasonable. That could happen to a company that's mature or starting to even decline, right? Now, if you start putting in a negative growth rate, which, by the way, just mathematically, in perpetuities, G can't be higher than the WACC, right? In cash flow divided by R minus G, G is bounded by the R. That's just math outside of this class, okay? But let's say you forgot that, right? and you use GoalSeek or some other thing, and you came up with some negative G of like negative 20% to get to that actual PE. Well, then the problem is gonna be, take this company's revenue, all right, Estee Lauder, in this case, I'm on the Procter and Gamble part of the screen, and shrink them 20% a year every year. Like, they're gonna be basically gone in less than a decade. And they're gonna be a teeny tiny firm. Well, in no EEO scenario is that likely to happen, right? So that's the other thing, we gotta be very careful when we do these long-term Gs. Like, can you have a negative G? Yeah. But if you have a really big negative G, what you're really saying is the company's going out of business. And I don't think that that's what these multiples are suggesting about these companies. And so that's just what made this a little bit more challenging than, the Costco, Walmart multiples, right? Because for them, today looks a lot like tomorrow, right? And so it just so happens with Estee Lauder, it was a little bit of a ditch, which they are climbing out of. And so the question is, what do we give them credit for? And so in my analysis, I gave them credit for a 33% ROE, and therefore the corresponding ROIC long-term of 30%. Okay? And the way I got to 30% is I looked at their WACC. And I saw that Estee Lauder is basically 85% equity and about 15% debt. So a debt to equity ratio, right? So they don't have a lot of debt in their cap structure. So said a different way, their ROIC is going to be somewhere around 85% of their ROE. Because if you look at it as a leverage ratio, there's not going to be too much leverage in that company. Which leads to the other file that I uploaded. So also in the solution folder for week 6, which is here. And I'll make sure I made it available to you. I put it in a second file called homework help. Okay. And this is something one of my TAs did for the undergrads in my spring semester last year. So I'm sharing it with you for your final projects if you need to use this. But the idea of the homework help file is just kind of talking about what we did last week. So let's go back to Excel. Let's see, I moved the file. Here it is. And again, make this a little bit bigger. All right, so for Estee Lauder, as an example, I came out with an ROE of about 35%. Okay. And so the idea is that if you take your ROIC and you multiply by your leverage ratio, you kind of see the formula there, right? Which is the debt to equity ratio, 1 plus the debt to equity ratio. You can get an estimate of your ROE. They should be relatively correlated. Now it's a loose correlation because one's based on net income, the other's based on NOPAT, operating profit versus net income. But it's at least an approximation of the debt to equity ratio. But the idea is there should be a correlation between the ROIC and the ROE. So it didn't have to exactly be this debt to equity rating, but I'm just telling you that you should have an ROIC substantially higher than whether it was 5% in perpetuity. Because that's the only way you're going to get a reasonable valuation with a multiple of 22. And as I said, it needs to be somewhat correlated by the ROE. So going forward, if you want to use this kind of like handy dandy leverage calculator, which I put in there, the idea is if you put in an ROIC, then it basically gets you an expected ROE. What I did is I just worked backwards. So, okay, based on the ROE, without using GoalSeek, approximately what ROIC gets me to approximately that ROE. And since I did this for Estee Lauder, I decided to do it for all 3 companies, for both Procter & Gamble as well as RKT. So that's where these numbers will be coming from when we get to the ROICs. But back here to the PEs, this would be the PE multiples for Estee Lauder 33, Procter & Gamble about 34, RKT was lower at about 27 based on looking at the next 4 years, and then solve for the Gs. And the whole point is what's really different about RKT and their low multiple, we get to the analysis, is this very low growth rate. Said a lot in a short period of time. So pausing, questions. Let me put up this other file. It's called Homework Help in the week 6 folder. Makes sense?
Is that the only way though to solve
No,
it? Okay.
no. And again, I want to go back to my original point. What we're trying to do for both these numbers and for these numbers is put in what we think is representative of perpetuity. Okay? So that's the whole point. The whole goal here is to do what we think is perpetuity. Now, ideally, this is why it's helpful to do an as-is DCF valuation, because when you do an as-is DCF valuation, you're more likely to get a reasonable ROIC into perpetuity. Okay, so that would be kind of a preferred method, right? But we didn't have that opportunity to do that here. Okay, so the question is, okay, then how do I come up with what is representative? So option B is going out of order to say that ROIC and ROE are sort of correlated, and they should be correlated by the debt to equity ratio, which is something we did cover last week. And so the question is, for a company like Estee Lauder, if I see a dramatic increase in ROE, then that suggests a dramatic increase in the ROIC. And if I really believe that near the high end of this is what Estee Lauder is probably going to do long term, then the ROIC should be that accordingly. All right. And I could have done a similar thing, which I did for Procter & Gamble, which saw an ROE in the low 30s, which suggested that today and tomorrow are not that different, right? And I could have done the same thing for Reckitt, which saw an improvement, right? So this suggests that yesterday doesn't look like tomorrow. And the question is, does tomorrow represent the future? Which leads to method number 3, which is I can make some inference based on historical data. Okay. So the one that I would just say, if you use that third method, and I'm not going to, because this was a more complex assignment from this context, the only one that I will kind of hold against you is if you use the historical Estee Lauder ROIC. Because if you use that 4.78, there's just no way you're going to get a reasonable G in this assignment. You just can't. And so that one, you would have had to come up with a different number. Now, for the other two companies, if you had used, for example, 18% for Procter & Gamble, right? Personally, I think I would use a slightly higher number. I did in my solution, but I will still give you credit for using 18% because you're going to get a higher G than I got, but that is at least explainable, right? And the same would be true for Reckitt, right? With a zero spread, it's really hard to get a high ROIC or a high multiple. Like if I put in, see this here, if I put in 8.1, oh, I'll start. If I put in 8.1, what kind of G, I mean, even if I put in like 10%, which is higher than the WACC, which you can't do, like it's going to be hard to get to that EV to EBIT multiple. And I've already broken the idea of a perpetuity because my G is higher than 10%. Because that's the whole point. If I have a tiny spread, the only way with a tiny spread that I'm going to get a big value is with a lot of growth. right? And so I'm gonna have to have an unreasonable amount of growth in order to get that multiple. So this one, I would have had to realize that maybe last year isn't representative of perpetuity and what had change. The only clear one that could be last year equals the future is Procter and Gamble. These two companies became more tricky. In fact, I don't even know if it will goal seek. I didn't try. If I go 8.1 and I goal seek, set my EV to EBIT to 10.48 by changing the G. I'd probably have to get something like that, which is possible. But here's the interesting thing. If you go back and you look at the EEO, you don't see that growth rate, not even in the short term. So it's almost like they're going to grow a couple percent a year and then suddenly they're going to grow 6% into perpetuity. Like that just seems harder to believe when you kind of think about the math that you're actually putting in there. Can't just plug and chug. So
So
yeah,
if we use the numbers from the spread, it was wrong.
well, you're saying if you use these numbers,
Correct.
what did you say to write up?
Well, I stated exactly what you told us in class about how it looks off and everything, the EPs. Yeah. Because even I went back and I looked at your recording, and the recording told you specifically said use what's on the spread. Don't use the math. That's something we'll go over in the next class.
Yeah. Well, as I said, if you ended up doing it this way, and I did say you could use the historical data for RKT, then I'll have to give you credit for that. But ideally, that wouldn't have been the better answer. But for Procter and Gamble, you really couldn't use the historical spread. That's why I made the announcement yesterday, day before, whatever it was. But that being said, given that we're talking about this now, whoever made that comment, sorry, I'm having trouble seeing you guys with my screen full. Does it make sense what I'm talking about with the low spread, why that's harder to justify for RKT?
Yeah, it doesn't make sense at all.
It does or does not?
It makes sense what you said.
Yeah. Well, that's again, whenever we're doing any of this, there's kind of and hopefully after 6 weeks, this is starting to come through. Sorry, my dog was going crazy in the background. There's kind of the quantitative side of the valuation, the process, the math, etc. But then there's kind of the art, and that's about what assumptions are we putting into the formulas, and are those assumptions reasonable? And that is really the other side of what we're trying to better understand here. And obviously, it takes a little bit more experience, but that's what we're starting to see, even when we're doing these as is and the various valuations, which is carrying over the multiples, is that we have to, as I tell my undergrads, you can't just plug and chug. You got to think about what assumptions you use to solve this, and do those assumptions make sense? So it's almost like you always take a step back from the math that you just solved. It says, okay, I know I solved it, but is that the right thing that makes sense conceptually? That's also why I like to do the 5 rule papers, because when you have to explain in the business context the numbers that you see, it tends to call things like this out. Because it would be hard if we were to do an EIC justification of RKT in a market that's not growing that fast, for them to suddenly go to that level of G long term, and that would start to jump out at you more. But for this assignment, if you use the historical for RKT and got a higher growth rate, I won't penalize you, but I want you to realize that was not less than ideal.
What about for Estee Lauder, like comparisons to other companies in order to get that ROIC?
So if you wanted to use, and that's not a bad method number 4, So let me undo this. Just get back to the solution. So one of the other methods that I think you're highlighting, if I have your comment correctly, is to say, okay, I'm going to use one of these peers like L'Oreal or somebody like that and say that, or some other company, or even industry average, and say that that's probably more representative of the long term. Is that what you're basically saying?
Yeah.
That's another possibility to do it that way. But think back to when we did Costco and Walmart. Can you really use Walmart as and say, oh, well, they're just going to have the same return as Costco long term, when Costco has such a productivity advantage over Costco or over Walmart, which is driving them a higher ROIC? Like, you start to see that that's kind of what you're doing. I'm not saying that, you know, as a methodology, if you lack other things as a proxy, but that's what you would be saying. You're saying, if I'm going to basically say that Estee Lauder is like L'Oreal, then they really should be like L'Oreal. So similar margin, similar productivity, similar return, similar growth. But these are good questions and good thoughts about this. Other questions or thoughts?
I got a quick question.
Yes.
So are you basically saying, so if you're going with the third method, on one of them, one of the companies, so you prefer to change it all to be the
If
same
you
method?
go, if you go with method number 3, what I'm saying is, I don't like the third method for RKT, but I'll accept the third method for RKT. For Estee Lauder, the third method just doesn't make sense. And that one you would have had to change.
Right.
That's why I made the prompt with the announcement.
Yep.
But
Gotcha.
ideally, the third method for this is not the one we should have done. We should have done 1 or 2.
Got it. Thank you.
Sure. And by the way, if you go back a couple weeks ago when we did the lecture on multiple analysis last week, whenever it was, at the beginning, I said this is one of the challenges with multiples. On the one hand, they're easy, which makes it beneficial, but the other side is the easiness actually makes it hard, because you're trying to represent the entire future of a company down to essentially 4 numbers. And getting those 4 numbers to be realistic in perpetuity based on today's results is not as easy as it sounds, right? And that's what you're starting to see, because slight differences in G can have huge impacts on valuation. Okay, so that's one thing. And then the final method, by the way, we'll call it method number 4. It didn't occur in this exercise, right? But let's say that, let's see if believe. Who's got the auto company in this class?
Our team, we have Ford.
Okay. So I'll give you a little bit of a hint. I think I got logged out of Bloomberg on what challenge you're likely to run into with Ford, because they're a really good example of this. Ford. So if you look at Ford's multiples, first of all, their PE is 5, right? And so you already know from key value drivers that to get a multiple of 5, it's going to be a really bad growth spread combination. Okay. And that's kind of what you're going to start to see here is that the return on equities are reasonable, but with a 15% return on equity, like you're probably not going to get a 5 PE without, at that cost of capital that they have without a big negative growth rate, right? Because Ford, unlike the other companies we've looked at, has a lot of debt in their capital structure. They're 75% debt, which means you're going to actually have a relatively low ROIC. And you can use that homework helper file I gave you to kind of look at a correlation. But the problem is when you do that, you're going to run into a question where if the company is a negative spread in perpetuity, then you could end up having a negative growth rate to actually solve the equation, right? And a negative spread going negatively doesn't suggest a good situation for any company. And when you kind of think about that out loud, it's harder to justify. So what you end up having to do, and this is the exception to the rule, is what we've been doing this semester in both DCF and the some degree multiples is key value drivers are 3 numbers. It's growth and spread, growth, ROIC, WACC. We're leaving the WACCs alone with the assumption that the capital structure is not going to change long-term unless Bloomberg, which every now and then makes an error, like usually the WACCs are fairly reasonable. So we leave the WACCs alone. So we're trying to solve for growth and ROIC. And the whole point is that ROIC tends to be a little bit easier to forecast in perpetuity than the G because slight changes in G have big impacts. So know the WACC, know the ROIC, solve for the G. As we did for DCF as is, and to some degree what I'm having to do with multiples. But every now and then, figuring that our ROIC in the future in perpetuity gets a little bit more challenges. And I think Ford's a good example of that. Because the next few years, Ford is just not doing well because they're spending all this money on electric vehicles. They're not having a lot of success with them. Starting to pull back off of that. And their truck franchise is a little bit in trouble. I'll hear more about this next week for the Ford team, long term. But the whole point of the story is sometimes what you might have to do is estimate a G and then solve for an ROIC. So you say, here's an auto company that's kind of growing with the automobile industry. The automobile industry is growing like 1 or 2% per year, okay, in terms of size of the pie. So Ford's going to grow around the size of the pie. You put in a G of like 1.5%, making up a number. I'm not telling the Ford team exactly what to do, but by proxy. And then you say, okay, goal seek the ROIC. So tell me what ROIC is reasonable in perpetuity given a growth rate, right? As I said, this is like 5 to 10% of the time, okay? Most of the time, it's more efficient to forecast the ROIC to get a growth. But sometimes when you're forecasting the ROIC, you're going to have trouble. And so this is something you might have to do. And so as a Ford team, if you're struggling with your multiples for some of these auto companies, because some of your peers are also going to have very low multiples and likely negative spreads. Because unless you choose Ferrari, I think that was the only company in the industry that had a positive spread we looked at earlier this semester, like you might have to deal with this. And so that's what I'm saying as a method, pick a G, create the ROIC. Okay. Less than ideal, but it might be necessary. But that's actually, again, gets back to what makes multiples hard because we're trying to represent very long-term values starting today in perpetuity with 4 numbers. And it's very much a blunt instrument approach. Okay. That's why when people say, oh, multiples are so easy. Well, yeah, they are. And on one hand, but when you kind of dig into what making the multiples and the math work, then it gets to be a little bit more sophisticated than we really think. So hopefully I'm illustrating that here today. And by the way, what we're talking about here is not beginner. Like what you learn in your first finance class, what most people get to with multiples is very beginner, right? This is much more of an advanced approach to multiples. But that's why it's called the advanced class. So, but anyways. Hopefully everybody's following that. Questions, comments? Raymond?
One question, do we go through how to use the leverage ratio to get the ROIC?
So we kind of did, but let me at least pull up the homework helper file because I think it's a good illustration. There is, sorry, this menu is in my way.
I mean, is it nothing more than just what you wrote in the,
Well, it's what we covered. Let me go back to the homework helper file. So we kind of covered last week, okay? And the whole idea here, and I'll use my.
yeah,
draw-
I apologize for interrupting. I saw that from the lecture last week. I guess my question was, is there any further review of that? Is there anything deeper we go into, or is it just what we covered last week?
It's what we covered last week, and then I'm giving you this file, which basically says if you take your ROIC and you multiply by the leverage ratio, you get an approximate ROE. But what I want to remind ourselves of, and that's why I'll at least draw this part. If I'm talking about ROIC, profit over investment, and I'm talking about ROE, which is profit over equity, okay, I can make the algebra work to get to the leverage ratio times debt plus equity assuming that there's a couple assumptions that are being made here. I just want to call them out. Okay. So we're saying here, this is debt plus equity. So the first problem is what I'm writing here. I'm saying that ROE is profit over debt plus equity. Well, that's actually not operating ROIC, right? That's a kind of like shortened version of ROIC that people use because remember, debt plus equity would equal all of the assets of the company, not just the operating assets and operating liabilities. So that's one of the challenges with this approach. Challenge number two is the P. The P on the left in the ROIC is NOPAT. The P on the right is net income. So we're basically saying it's the same P, but it's really not. They're approximately correlated, NOPAT and net income, but they don't have to be. And so there's a couple of kind of things that we're doing here when we're shortcutting that I want you to be aware of. That's why I'm saying it's correlated. This math doesn't work out exactly to these numbers. So that's why plus or minus 1 or 2% on either side is probably okay. You don't have to be mathematically exact to 1 to 3 decimal places here. But
Got it. Thank you.
they should be correlated. Right.
Understood.
You
Thanks.
can't really have a negative ROIC and a positive ROE. Like, I don't see that happen. You can't have negative operating profits and positive income. I guess you could get giant, one-time events or non-operating income, but that's very unlikely for the vast majority of companies. So that's good back to you have a high ROIC, you should have a high ROE. But that's the other problem. Let's say the company bought back a lot of stock. It could actually distort the ROE. And that could also cause some disconnect in this equation.
Got it. Makes sense. Thank you.
Great questions. Any other questions? All right, so let's go back and talk through the analysis. So once you got these numbers, I'll do the analysis based on my solution here. Why is Procter & Gamble trading at a slight premium to Estée Lauder? And it's slight. I mean, their multiples for, let's start with PE, are pretty close together. Estée Lauder slight premium to Procter & Gamble. 23 versus 22.64, 23.19, 22.64. I mean, basically what's happening is Estée Lauder has a 6% growth rate versus a 4% growth rate at Procter & Gamble at, to some degree, a similar spread, right? Slightly higher spread at Procter & Gamble. But the flip side is Estée Lauder has a higher cost of equity at 9.6 versus 8.1. So what they're getting in the higher growth, the extra 1.9 percentage points of growth between the two companies, that's helping the multiple at Estée Lauder is being offset by the much higher cost of equity, which is being discounted back down to the 8.1% benefit that Procter & Gamble has for their cost of equity. In terms of why is RKT have the lowest multiple and trading at a big discount, 11.97 to P&G? Well, again, it's the low G, the 1.22% G against the 4% G of Procter and Gamble at a lower spread, but it's still pretty high spread. 27 minus 9 is a 18-point spread, right? That's pretty good, but it's lower spread than P&G at a much lower growth rate. So if you don't grow that spread, you don't create as much value. That's the accelerant. And they just lack the accelerant at RKT. And that's why they're trading at a discount at 11.97. They also have a much higher cost of equity than P&G, 9.2 versus 8.1, which also tends to lower the multiple even further. Questions about premium or discount? On the operating multiples, P&G, again, and Estee Lauder, very similar to EV to EBIT. This time, Estee Lauder is a little bit of a discount to P&G. Remember, in the PE, they were at a premium. Here, they're a little bit of discount, right? Similar, but why are they trading a little bit of discount? 18.17 versus 18.64. Well, one thing is Estee Lauder, again, has a much higher growth rate of 5.8% versus 4% at Procter & Gamble. And they both have somewhat similar spreads, 31 minus 8, 30 minus 9, slightly higher P&G, but pretty similar. The thing that's hurting Estee Lauder is, despite the higher growth rate, they're paying a much higher tax rate at 35% versus 21%. And again, we're discounting those cash flows at 8.7 versus 7.7. So the much higher discount rate and the higher tax rate is offsetting the growth advantage that Estee Lauder has, and that's why they're trading at a discount. Why is RKT trading at a discount? Well, it's similar. On an operating basis, their risk is pretty similar to P&G, 7.7, 7.9, not too different. Okay, they do have a lower spread, 21 versus minus 8 is about 13 points versus the higher spread here, but they don't have the growth. 1% growth versus 4% growth, even at a reasonable good spread, and higher taxes at 25.5. So RKT is trading a discount because of these two variables. That's why that multiple is much lower than P&G and to some degree Estee Lauder. In terms of EV to sales, why is Procter & Gamble have the highest EV to sales relative to Estee Lauder? Pretty clear between these two companies is the margin. Estee Lauder's margins are expected to be substantially lower than Procter & Gamble's. 13% operating margin pre-tax versus 25%, 9% after-tax margin, operating margin, NOPAT versus 20%. So even though Estee Lauder doesn't use as much capital to drive sales, 0.29 to 0.64, it's that high margin that is giving Procter & Gamble a high EV to sales. Let's pay a lot more for those sales. Why is RKT, which has such a high margin, 23.7%, see their EV to sales substantially lower than Procter & Gamble and even lower or almost as low as Estee Lauder? Two reasons, but the big one here is they do have slightly lower margins than P&G, 23.7 and 17.6, but they spend more on capital and they're not growing those margins at all. So the lack of growth is really what hurts Rakuten's EV to sales. I'm going to make decent margins when I sell things, but I'm just not going to grow those sales all that much. And so people aren't paying a lot for their revenue because they lack the growth and they're spending the most, 0.84, to drive those sales. Now, you might have a variation of this because if you had a very high G at RKT and you had a low spread at RKT, then you would have to explain that it's the low spread at RKT that is actually the reason for the discount for the EV to EBIT along with the higher tax rate than P&G. Okay, so that would be the permutation, but that's the difference in the way you would have to explain it in the math. And as I said, when you start to do that, it's harder to believe that RKT would have the higher growth rate when you start to look at that EEO. But again, I'll accept it for this assignment, but not next week. Any other questions about the homework?
Yeah, I have a question.
Go ahead.
Since this is a perpetuity, is it reasonable or acceptable to keep the 35% tax rate? Are there any issues with keeping such a high tax rate?
No, it goes back to what do you think is reasonable for the company in the long term? And if you really believe that their guidance of 35% is not representative of the long term, and you thought that their tax rate should be 20-ish, then put that in and explain that that's why you made that assumption. And so if you did that in this assignment and you said that, I'll give you credit for that because I think it's actually not an unreasonable assumption to make.
Okay,
But that's why, and again, I'm gonna sound like a broken record. Whether it's this class or the real world, what separates the good finance people from the mediocre finance people are your assumptions that you make and your ability to explain them. Okay, that's a skill. And the better you are at that, the more helpful it will be in your careers. Because anybody can solve an equation, right? You wouldn't be in this class if you didn't know how to solve the math. This is algebra, right? But do you know why you're solving it? Do you know what it means? That is an amazing skill set to have. And that's what we need to practice. And that's why I go back to here, even if we disagree about the future, if your assumptions make sense, then I can't say you're wrong, right? If your assumptions don't make any sense or you don't give any assumptions, that's when you start to get much more challenged. All right, you have the two files. And before we save. Assignments. Let's talk about your midterm exams. I'm sorry, your final exam. So starting on August 20th, 1 week from today, there will be a final exam. That exam is going to be 10 multiple choice questions, each worth 2 points. It will be open book. It will be no collaboration, individual exam. And it'll be timed so that you have to complete those 10 questions within 4 hours, which shouldn't be a problem. And you will take that exam anytime over that 2-day period. So it'll be available starting August 20th at midnight, and you have to finish by August 22nd at 5 p.m. So translating that into days, August 20th is Tuesday. So basically, it'll be available anytime Tuesday, and you have to finish it by Thursday at 5 p.m. The exam will be auto-graded by Helms because it's a multiple choice exam. So when you submit the exam, you'll see your grade. And again, 10 multiple choice questions, 2 points per question, worth up to 20 points for the final exam. Yes.
Some of us, excuse me, are in class on Wednesday nights as well. Is there any way to extend this till midnight on even Thursday, just to give us till after work Thursday if needed?
I will do that right now.
Thank you.
My only reason for not giving you other days is that the MBA program wants you to have your grades in that week. So
Sure.
can't go too long on this, but I'll make it 11:59.
Yeah, that just helps with like the Wednesday night class and then work on Thursday.
Yeah, but again, I don't think it'll take 4 hours, just to be really clear about that. So do this right now while we're talking. 11:59 p.m. All right, well. You get to 11:30. So turn it in by 11:30. Apply. But again, 4-hour window, just make sure you take it all at once. So don't open the exam and come back to it later because I'll start the timer. And again, it's open book, open notes, fair game, anything that was in the book, anything that was in lecture notes, anything we discuss in class. But I'll tell you, if we didn't talk about it in class in the lecture notes, it's highly unlikely I'm going to ask you about it on the exam. So questions about the final exam? 1 week from today. Thomas?
Are the questions going to be mostly conceptual, or are they going to be more math and running Excel files and whatnot?
You won't need to use Excel to answer the questions. So it'll be something like this, and I'm going to riff one. Which of the following would improve your ROIC? A decrease in NOPAT, did I say increase your ROIC? Decrease your ROIC. Decrease your ROIC. Increase in NOPAT, decrease in tax rate, increase in non-operating liabilities, a decrease in property, plant, and equipment, none of the above. Those will be the types of questions you're going to get.
Okay, thank you.
By the way, if I got it right, the answer should be none of the above. So I'm riffing. But all the questions will have none of the above. Other questions about the exam? Just individual exam. No study buddies in this one. All right, so let's talk about the group projects. So under assignments, for our final week in class, under week 7 presentations is what you need to do for your group projects. So here's what they're going to involve. And we're going to have a very packed week next Tuesday. So each of your 7 teams is going to do a 20-minute PowerPoint presentation. So there's no write-up, but you're going to do the PowerPoints. Everything that you talk about, including the data, needs to be in the PowerPoint. So if you don't have data in the PowerPoint, I won't give you credit for it. So for example, when you're talking about the betas, you better have a screenshot of the beta, okay, to refer to the data that you're talking about. When you're talking about your models, and you go through the multiple models, you should have a printout in the spreadsheet, probably of your assumptions and ratios tabs. So you could show what you changed across each of the 4 models that you're referring to, right? The entire presentation is going to be done in PowerPoint. You're not allowed to go to Excel, okay? So everything needs to be in that PowerPoint presentation, okay? The presentation will cover essentially the 4 sections we covered this semester. So approximately 5 minutes per section, and all of the team members must participate in creating the presentation. And I said paper, you're not actually turning in a paper. So you're going to have to split up who's going to present so that everybody is presenting. Okay. So you need to turn in a copy of the PowerPoint and Excel files by 5 p.m. next Tuesday. And what's going to be in your PowerPoint. So you're not going through the Excel files. I still want to have them handy when I'm listening to you to know what the data is based upon. So covers the 4 sections of the class. So start out with here's what company we're valuing and your buy, sell, hold recommendation. That should be right up front on page 1 with the target share price, as well as who are all the team members on your project. First part of the presentation, approximately 5 minutes, is an EIC, similar to the EIC assignment, except it's just going to be verbal. So you got to refer to the economic sensitivity, referring to company and industry beta. You got to do a 5 forces, of today, 5 forces in 5 years, explaining the spread and whether it will change. And you got to talk about whether the company has competitive advantage. Again, you need that refer to the screenshot and the data. And if that's going to change in 5 years. Section 2. Historical. You're going to have an ROIC tree and a full CFI.
Professor, looks like there's a question.
Oh, go ahead. Wade?
Yeah, under the industry section, you did mention there's like a write-up in the writing there.
There's not a write-up.
Right.
Long. Oh.
Thank
Let
you.
me ask this. Do you want to write a 1,000-word paper? I can leave it in.
No, thanks.
Yeah, I don't want to grade it either. I just want to hear the presentations. So PowerPoint. So I copied this assignment over from a previous semester where actually they did have to write papers. Industry, 5 forces, company, advantage today and in 5 years, similar to your assignment. Historical. You got to do a full ROIC tree analysis and a full CFI analysis. When you do the ROIC tree analysis, make sure you cover both levels of the tree. Okay, so tax rate, margin, productivity, gross margin, SG&A, depreciation, working capital, PP&E, goodwill. Okay, so changes for both levels of the tree over 5 years. And for the CFI, you're now doing the full CFI, so you're doing all 4 sections. So you're not just doing free cash flow, you're also doing non-operating cash flow and the debt and equity cash flows. Okay. Multiples. You're going to do a 3-company multiple analysis, your company plus 2 peers. And shortly, we're going to talk about the peers that you're going to choose. But basically, I'll give you the data for that. And then, as I said, similar to this assignment, you're going to estimate your G's and come up with an analysis of premium or discount your company against the other 2 for PE, EV to EBIT, and EV to revenue. And then finally, section 4, you'll do the valuation. Okay, you're going to, based on your 4 Excel models, you're going to basically start with your as is. What were the key assumptions? Easiest way to do that is to have screenshots of your assumptions tab as well as your ratios tab and highlight what you change across the 4 models. So here's my as is. This is what I did for it. Here is what I changed for the bull and why I changed it. Here's what I changed for the bear and why I changed it. Here's my target, why I changed it. And that led to that buy, sell, hold recommendation that we gave you at the beginning of the presentation. Okay. And then that's your 20 minutes. I will warn you, because I'm going to have to hold you to time. Otherwise, we'll never finish next week. It's a long class. Right. So you got 20 minutes. At 20 minutes, you're going to have to wrap up. If you don't get to it, I can't grade it, no matter what's in the PowerPoint. So make sure to practice and mind your time, because what tends to have gone awry in previous semesters is the person or people that do EIC tend to run long because it's just a lot to cover, but it has equal weight to the other 3 sections. So if you spend 10 minutes on EIC and you run out of time on valuation, it's going to hurt your team grade. Okay, so make sure you balance getting all this done in 20 minutes. So I say approximately 5 minutes per section, but I'll leave it to your teams, but you got to cover all 4 sections. And again, I'll pause. Does this make sense? Questions about that? Thomas?
So the 5-minute Q&A at the end is on top of the 20 minutes.
Correct. So the next thing that's going to happen is tonight, I'm going to assign you one of the other teams, and you're going to act like sell-side analysts listening in on an earnings call. So you're going to listen to the presentations along with me, and you're going to then ask them some questions about their presentation. Okay, so 5 minute Q&A about another team's presentation that you will be assigned to. I'm not participating in that Q&A. I'm going to let it run between you and them, but that is part of your grade. The team that's doing the Q&A on both sides, you'll be graded as part of that. Because if I go back to our syllabus, here's the syllabus. The way this final project grade I put it. Here it is, investment committee. So each group will serve as an investment committee for the other group. In this role, you'll observe, review their presentation, run a 5 minute Q&A immediately following their presentation. And then by the next day, you're going to give, if you're the investment committee for the team that's presenting, you're going to do a 1-page assessment, essentially grading the team that presented. And why you liked or didn't like what they presented in the context of this class. Okay. And those write-ups are going to be due by Wednesday at 5 o'clock. Okay. So that's one of the things that has to be turned in next week by a second team. In addition, you must submit a peer review of your teammates. And this is going to be due by Friday of next week. Okay. And the idea is everybody gets the group grade up to 40% of your grade. So let's say you got a perfect score. Everybody got 40 as a 40. But let's just say one of your team members didn't do anything. And they didn't really help. They didn't show up for the team meetings. They didn't really provide any analysis. They just were AWOL for whatever reason. Well, it wouldn't be fair for them to get the same group grade as everybody else. So basically, you need to peer review all the members of your team, including yourself, and basically saying, how much help did they give to the presentation? If they didn't do anything, give them a 0. Okay. And if they didn't do much on a 1 to 5 scale, 5 would be equal participation. If everybody kind of equally participated within reason, give them 5s. If they didn't, give them below 5s, right? If I see more than one peer review below 5s, then I will consider lowering your grade. If one person says you didn't participate, I'm not going to lower your grade. But if I start seeing a pattern of 2 or more, I will lower your group project grade accordingly. So those are the peer reviews, which are going to be due next Friday. Investment committee due next Wednesday. Presentations due next Tuesday. The way the grade's going to work is I'm going to grade 80% of your presentation. 70%, the 4 sections equally divided. Did you do the analysis and what was required? 10% is going to basically be presentation style, right? Did you use numbers? Were you coherent? Did what I hear make sense? 10% of your grade will be the investment committee. So that 1-page write-up is basically to give 10% of the grade to the team that you're writing up. And then teamwork, I'm going to start with 10%. Everybody gets 10%. But I'm telling you, if people give you a bunch of 1s and 2s, I'm not just going to knock off 10% out of the team grade. All right. I'll give you a 10 or a 15 out of 40 if everybody starts giving you 1s and 2s. Okay. So generally, the teamwork is an easy grade if everybody participates. And I'm hoping everybody does. Wade?
Yeah, I'm seeing the due date for the peer review under assignment is August 22nd. Just want you to be aware. And then
Sorry, let me make
Mm.
sure I get that right. So review should do August. I gave you 3 days. So what's Friday? What's
23rd.
23rd? So let's do the 23rd. So it should be the 23rd. So I'll give you the 23rd, 3 days. 5 p.m. Make sure I adjust that now. Thank you for pointing that out. So there was one other question or comment you're making? Or is that it?
Yeah, I'm assuming you want us to submit all the files under team presentations. That due date is on the 20th.
So in terms of submissions, where it says week 7 presentations, you should submit 5 files. There should be your PowerPoint and your 4 Excel models, the as is, the bull, the bear, and the target. The investment committee write-up for the other team should be submitted here. And the peer reviews, you can email to me, or technically I'll let you submit it here as well. Actually, make it easier. Why don't we submit it here? I'll change this to an assignment. So you just submit it here. 1 to 5. And the easiest way to do it, I do it in Excel. Just open up a worksheet in Excel, put every team member's name in a row, and then put a number 1 to 5 next to them. Hopefully everybody gets 5s. 5s means everybody did a fair share of the work. I hope nobody gets 0s at this point. So I'll change that to a submission. Should make it easy. So you don't have to worry about a bunch of emails.
Thank you.
Now, thank you for pointing those things out. Lots happened in this last week, a lot of moving parts. Jonathan?
Yeah, sorry. Can you cover the 5 file submissions again? What did you say they were?
I believe it's actually in here,
Oh,
but if not, but basically it's your PowerPoint, your as is Excel, your bull and bear Excel, and your target Excel. So it's the 4 Excel files plus, here it is, Excel files plus the PowerPoint.
cool. Thank you.
And it keeps saying paper. There's no paper. So I'm sure it's here. Get rid of all references to papers. So no one's confused about that. There is no paper for this one. All right. Any other questions conceptually about that before we get into some details in the data? Thomas?
Say we happen to already write an EIC paper, would that give us maybe a little extra bump on the grade?
You mean you wanted, oh, you already wrote an EIC paper?
Yes.
You
We turn it in for extra credit?
But basically what I'm gonna end up grading is what you say next week. So hopefully you've just outlined what you're gonna say next week.
Okay.
So that saves you a little bit of time. Lucas?
Just wondering, as far as references, do you want us to list references in the back of the PowerPoint? Do we need to submit references?
Absolutely. Plagiarism is not allowed. So if you're copy and pasting tables or, references to analyst reports or something, then please put in a bibliography at the end or footnote something.
All right. Thank you.
Yeah. Ezra?
Yeah, so for the investment committee write-up, is there any way we could extend that deadline to also Wednesday night, just given we all have work during the day and then some of us again have class that night? Just give us a little bit of extra time.
Yes.
Thank you.
How about can you do it by, where's the investment committee? Can you do it by end of day Thursday?
Yeah, absolutely. Definitely end of day Thursday.
Okay. Today seems to be, make your request day. So
we appreciate it.
Yes,
Yeah. Busy last week of classes.
And I'm throwing a lot at you too. So I understand. So Thursday is the 20,
Thank you.
What day is that? Thursday is the 22nd?
Yep.
Yes. All right. 22nd by 5 p.m. And let me change this. Sorry for being granular, but given all the changes we make, I don't want to forget to do something and confuse everybody further. All right, so let's talk about data. Here is the team data that I've given you so far for all of your teams. Right. So what I'm going to do is for each of your teams, I'm going to basically create a new folder in here, which I'll just call like update or something like that, which will basically have the screenshots that I'm going to take tonight. Right. But here's the thing. Because let's say you're doing Adobe, because you're doing evaluation and as is, that valuation really needs to be at the same time as the multiples. Okay, so essentially, I'm going to re-give you all of these EEO, DES, WAC screenshots so that your DCF valuation syncs up with your multiple analysis for your company. So I'm going to leave the files I originally gave you on August 4th last week in here. But tonight, I'm going to put another folder in here. So I'll call it update. And in the updated formula folder, I'm going to give you new screenshots. So you should redo the valuation. Hopefully it's a couple quick tweaks if you've already done it to today's stock price. All right, because it's going to sync up with the multiples from today. Does that make sense to everybody? Okay,
Yeah.
good. So let's talk about two companies. Each of you are going to pick two companies that you're going to value in addition to Adobe. And as soon as we're done with this call, which is probably about 15 minutes from now, I will start taking the screenshots and uploading them in. So here is Adobe's list of potential peers. Custom. And I'll put the bigger ones near the top. So tell me who you want.
Can we do Salesforce and Intuit? Team, you guys are okay with that?
Yes. So let me file new. All right. So Adobe, Salesforce, and Intuit.
I was gonna say Autodesk.
I'm okay instead of maybe Salesforce.
Yeah.
That
So
works.
Adobe, Autodesk, and Intuit. Those are your three?
Yes.
Yes.
Thank you.
Oh, well.
All right. And then for, let's go next. Coke.
Can we do PepsiCo and Dr. Pepper Keurig?
So I don't have to need to go to the screen. Sure.
Unless you hate those options, those seem like the
No, those, without looking at the data, I think those are reasonable options.
Then we're good with it. Thank you.
Okay. Then for who's next? Dick's Sporting Goods. Let me see who's on your list. The RV list. So who do you want, Dix?
We were originally thinking like direct competitors for Sports Academy and Academy Sports, and Foot Locker, but yeah, so Academy Sports, I know we want.
Let me get you Academy Sports.
retailers, so. Um,
So was Foot Locker on that list?
Foot Locker, I don't know if it was on the list. It was just something that where they're trying to make it into the footwear market is why we were thinking that. So I just wasn't sure if that would be a good.
I mean, they're public, so I can get their data. So would you like me, I'll accept what you're saying. So if you want to do Foot Locker, I can get your data for them as
That
well.
would be good for us just to have a interesting comparable there for the wear market. And then
Foot Locker.
someone else from my group has a specific one that they think we should also do. If you want to put it.
Any objections? All right, sold. All right, Ford.
I think we're gonna go with GM and Stellantis.
So it's basically what used to be the big three.
Yep.
All right. You are going to have the most trouble with these of all the teams, just so you know. Who is next? And I say that just because all of them are going to have negative spreads. They looked terrible last year. To get to the values, you're going to have to make some adjustments. How about the Lulu team?
Yeah, I think initially I did have I guess I did do it on Nike and Adidas, but I guess those have shoe companies, they're not specifically sports ones.
Well, both Adidas and Nike are pretty big apparel.
Yeah, that's what I was thinking too. I think they're really big.
I think those are reasonable peers.
Okay, great.
They're all big in athleisure.
Okay.
And ironically, easier than Under Armour. Under Armour's
Yeah, Under Armour was doing terrible for a bit, so yeah.
so that one again would be like dealing with Ford and GM. Like they're struggling right now. Their numbers don't look good. So Lulu, Nike, Adidas, I think those are reasonable peers. All right. Then for Peloton, we see who your peers could be. Let's see.
We struggled to find publicly traded competitors to Peloton.
I'm looking at this list. I can't imagine that Smith and Wesson
Or Hasbro.
Sturm
We
Ruger
came up with
firearms
Beachbody and Life Fitness.
are they on this
there.
list?
I hope so.
What are they called? A trotty?
Beachbody.
Oh, Beachbody. Oh, they said e-trotty.
No, sorry.
Let me just see. Beach.
It might be under a different.
No, I'm just gonna see if they're public.
They are.
I can get data from them.
I think they might be under a parent company though. Do you remember what that was, Chris?
Because here's Beachbody. Is this it? Body W. They're a penny stock.
Ugh.
I don't think Beachbody would be if this is who you think it is.
I think it's, what was it called?
What about Life Fitness?
I think it's BODI is the company name now.
BODI. Oh, here it is. Beach BODI. Yes. Health and fitness company. Okay, that seems like it could be a competitor. Well, let me just check this for you guys.
All their competitors that we thought of were not publicly traded.
They don't have any multiples. This is
Yeah.
gonna be really hard because they don't make any money.
Okay.
So you don't have a PE or an EV to EBIT when you don't have an E or an EBIT. So you could try it, but this is gonna be real messy.
What
Can you
if we
check
picked a
life-
totally different company than Peloton?
Yeah, Smith and Wesson it is.
So you're saying you want to switch from Peloton to Smith and Wesson?
No, Sean.
No.
But we might, but I'm worried about finding good companies.
let's go
to
back.
for the other two.
I saw Yeti. Yeti looks like it could be a reasonable. I don't know. They do outdoors.
Really?
They sell outdoor stuff. Peloton's like exercise. I don't know. See, that's the problem.
Peloton. Peloton's indoor. by
Can you check
definition,
Life
I think.
Fitness?
Try this life. See, I'm glad we're going through this exercise because a few weeks ago when I was doing the lecture note and I was like, this is actually one of the most difficult part is finding peers. You have found the example. Like Peloton is not easy to find peers. Life Fitness. I can't private.
No, it's Lifetime Group Holdings, LTH.
Okay,
Just their ticker.
LTH. All right, let's make sure it's the right one. DES. Yes,
Yeah.
there we go. And let's just quickly check their multiples, make sure they have some. Yes, they do. Okay.
Woohoo!
TH, there's one. So Peloton, it's LTH. All right, we need one more.
Anybody know any? Did we look up Bowflex, guys? We
Yeah,
looked
they
up
were
Bowflex.
removed from the New York Stock
Oh,
Exchange.
right. They got
They're going out
cut.
of business.
Oh, all right. You probably don't want to do them.
Yeah.
Let's go back to Peloton.
What about like Planet Fitness or something?
It's a gym. Are they?
Is that would
Oh
be
yeah,
a,
they just. I think they just IPO'd. I don't know if there's gonna have a lot of info.
let's see, EEO.
Planet Fitness has been a company for a bit. I don't think it's.
Yes,
been-
they
I
have.
thought they
reasonable
only
numbers.
recently went.
All right, so PLNT. That would
That's
work.
fine with me.
Yep.
You sound very resigned to that one. That's fine with
We
me.
had so many good competitors that were just private.
Going out of
so-
business, bought by somebody.
Yeah.
All right, thank you, Peloton team. And then finally, Royal Caribbean.
Yeah, ours should be the easiest. Carnivals and Norwegian.
Yeah, that would make sense. There's not a lot of publicly traded cruise ships, unless you want to like say, problem is they go like Disney. Disney's so much other stuff. And Norwegian. All right, so what I'm going to do is very shortly here, as soon as this call is about to end, I'm going to give you guys the opportunity to work in teams for the rest of the night on your projects. I'm going to start getting these data from all these companies, including your own. I'm going to put in that update folder so that you'll have enough to do your valuations and then the multiple analysis on these companies, similar to the screenshots you saw in the last companies. So before we let everybody go, any final words or questions about anything? And I'll ask you this, would you like me to leave the meeting open? Do you want to like create your own breakout rooms on here? Or are you guys good just meeting outside of this?
I do breakout rooms.
What I can do is I can set up the breakout rooms. And then I'll let you choose your own rooms. And I'll create 5 rooms. And I'll just let the, I'll create, well, actually 7 rooms just in case. And then basically it's choose your own room if you want. And then I'll just leave the meeting going in the background. I won't actually close out of the meeting. So if you want to use the breakout rooms, feel free. And then essentially I will, what time is this? 8 o'clock. I'll close it at 10 o'clock. So I'll leave it open till 10 if you want to work that late. And again, even if you go out of the meeting and come back, you should be able to get into the room. All right, so the breakout rooms are technically open. Just basically you can choose your own room by just assigning yourself.
One really quick question for the multiples. Will ROE be included in the screenshots for the competitors? I noticed in some of the other uploaded data, it wasn't there, but it was then provided in some of the extra research you put in the folders. So I just
Well,
want to
what I'm going to do is I'll take a screenshot of, and what I do is I shrink the Zoom so it all fits on one screen. But like, for example, Planet Fitness, those are their ROEs for the next 3 years. So yes, you will have them. And again, for the DCF, I'll give you a 2 screenshot EEO2, so you get this column over here for the 5th year.
Awesome. Okay, thank you.
All right. Well, again, good luck working this week, and looking forward to seeing those presentations. Have a great week.
Thank you.
All right.
Professor, real quick, are you able to enable screen sharing for the breakout rooms?
Yes, it should be, but let me make sure. It should be enabled.
Okay, cool. Thank you.
All
Have a
right.
good one.
Thank you. Good luck, everybody.